Mortgage, and this is James. And so we're here tonight to go through our first-time home buyer program. And if you have any questions during the process, feel free to interrupt, and also we'll be available to talk to you guys afterwards if you have any questions. Also joining us tonight is Chris Bush with Elevate My Scores.
Hello.
And Chris is going to talk for a section about credit scoring and how it works and what you can do to improve your credit score and how that has an impact on your mortgage loan. So let's get right into how to get approved for a mortgage loan. This is the first class that we offer in our home buying series. So if you're standing at the corner of lost, confused, unsure, unclear, perplexed, disoriented, bewildered, you're exactly where everybody is whenever they first start out. It's really hard to know where to get started. So tonight we're going to talk about the easy way or the hard way to loan approval. So the easy way would be taking our path, and the hard way would be doing something on your own without any guidance. And we really do, James and I really do try to specialize with first-time home buyers. We really love first-time home buyers. We're very patient, and we have some really good programs, so it's kind of our niche. So where do I start? Well, knowledge is power, so make a plan and decide now to take the first step. And just remember that it doesn't have to be your dream home. It's probably not going to be the last house you ever buy. But just start somewhere and keep that in mind, and then mainly just stop paying somebody else's mortgage for them. Mm-hmm. So we're going to talk a little bit about buying versus renting. So first of all, especially in Austin, this model is for Austin, rents are definitely on the rise. So this company put out some data that we captured, and it predicts that there's going to be an 11% increase from 2017 to 2020. So you can kind of see the breakdown here. If there's an apartment renting right now for $1,271 in a couple of years, it's gonna be in the 13s. As you can see also, whoops, this is an actual example of apartment rents in Austin. So varying averaging between $1,200 a month and $2,000 a month for 2 bedrooms. So the really good news about all of this is that Austin has a high percentage of appreciation value. And James and I looked earlier today at some of the stats for the entire country and even the state of Texas. And the values in Austin are greater than anywhere else, just about. So the median home in Austin is now $335,700, and the home values have gone up over 8% over the last year, and Zillow predicts that it's going to continue to increase. So you can kind of see this chart here, and you can see the trend on how homes are appreciating. So that's a good thing. I'll let you explain this one.
Yeah, sure. So really just to summarize, how fast a home appreciates, it's kind of hard to quantify when you don't really know what you're getting into, but we all know that investing in the stock market or other investment vehicles is really popular, but for a dollar value, you're going to get way more bang for your buck from appreciating. And this example just describes putting $30,000 at 3% return in an investment vehicle will get you about $2,700 bucks.
Plus you're going to pay tax, a lot of tax on that capital gain. For sure.
And so same numbers, if you have a $30,000 down payment on a $300,000 primary residence with, that's 10% down, over the same span of time with average appreciation, you're going to accrue about $30,000, $27,000 on top of your initial investment, which is just, that's ridiculous rate of return. It's almost 100%, so relative to 3%. So appreciation is just a huge piece of owning a home. So not to mention the fact that it's yours, and we'll get into the other perks here.
Yeah, so go right ahead.
Yeah, obviously you can do whatever you want that the homeowner association allows. There are still tax benefits. People think they went away. They did not. There are some other pieces to it to incorporate. It's essentially a forced savings plan. Instead of just throwing your rent away, obviously on someone else's mortgage, it's requiring you to deposit money monthly into your savings account, which is your house. no landlord, blare your music, piss off your neighbors, so there's a lot of perks. Not to mention, and by the way, y'all, so I'm talking 30% of, so you do a poll of current individuals that do not own homes. About 30% of them put Fido's run space in the backyard as their primary reason for wanting to buy. So that's a
really
big
big
reason. Big time.
So we're going to talk about the mortgage process, and I always describe it as a big puzzle. And so, when we first get started, we're just dumping out like a bunch of puzzle pieces, and then we have to sit there and we have to fit the pieces together until it all comes together and creates a picture. And James and I are the originators of the entire loan process. So we're like the first stop. So the better loan we put together, and the more it makes sense, it has to get passed down through a lot of layers. So if we do a really good job up front, we put all these pieces in place, then as it gets passed along, other people that work on the loan can understand it.
And this process is really complicated, and this is one of the things that,
Oh yeah.
This is one of the pieces where, you get your money's worth, and when you work with a local mortgage company like us, we're going to put a lot more thought into this piece than, a bank employee that's hourly. That sort of thing. So.
Or somebody online. And truthfully, their business model is just much different than ours. They're going to just look for the simple loans, the ones that they can do in mass, in bulk. And so they're going to pass on anything that doesn't fit together really quickly. So
like
we like
pieces,
a challenge, though.
So, like a 10-piece puzzle is their preference.
Right. So step one in the entire process is the loan application. We're going to just kind of breeze through this. Basically, what we're looking for in a loan application is the whole thing is just a risk assessment. So in the end, the underwriter, whenever they make a determination on whether they're going to give you a loan or not, that's their entire thinking is how much of a risk is this. So some of the things that we're looking for and ask for on the loan application is a 2-year address history. And the reason why is because, we need to verify, make sure that you've either paid your mortgage payments on time or you've got a history of paying your landlord on time, right? But then also we're going back 2 years because we're just looking for stability, basically.
Can I ask a question?
Sure.
Okay, on the current address in the last 2 years, what if there's someone, because I've worked, that is living with a parent? Or, how do you measure that?
Yeah, we do have that, and we have some people that live rent-free. Normally, James and I just supplement that with a letter from the borrower explaining the circumstance that they're living with a family member or that they're not paying rent.
But they would like to see some kind of rent being paid, correct?
It's a plus, and it really depends on the loan type.
And this is where layering risk comes into play, because if that's one piece, but then we're looking bird's eye view, and you've got other good pieces, then they can offset. For sure.
And if there's a story behind it, if you're living with a family member because you're trying to pay off debt or you're trying to save money, or you've moved in with your elderly parents because you need to take care of them, or there was some blip that happened, or maybe you're a student, you just got out of college. So they want to look at the entire picture to make sure that this thing makes sense and that this piece actually fits in place. So it's definitely something to consider, but it's not necessarily an obstacle. It just needs to be explained properly right up front so that things continue to move smoothly throughout the process. Marital status, Texas is a community property state. We have a lot of people moving here from out of state, so we do have to explain to them if, you don't necessarily have to have both people on the loan, but when you go to closing, everybody has to sign the deed and the notes, so just be aware of that situation. And then we have some complex situations where we have people that are one spouse is wanting to live one place and another spouse is wanting to live in a different place. So how does that present itself? Where's the primary residence? That sort of thing. And then Texas is unique in Alaska as well. We have homestead protection here. So then we explain to people how homestead works and how they apply for it and what it actually means. So just something to be aware of with Texas being a community property state, and don't recognize separation. So people who are in the process of separating or being separated, we got to get that wrapped up before they can move on, or they just need to be aware that the spouse is going to be owning part of the property as well. So that's about all there is to say on that right now. To your employment history, same thing, we're looking for stability. We ask a lot of questions about income, if you're self-employed. It takes a little bit more effort to figure out those calculations correctly. We like to go ahead and ask for 2 years of tax returns right up front, and maybe have the underwriter look at the tax returns before we even go into the loan application process, which is something really nice that we have available as a tool at Infinity. And then, you know, do you get a W-2 or are you 1099? And then do you get any overtime, bonus, or commission? We always ask this question too. And the rule on this is that it's got to be consistent over the last 2 years. We have to verify it with the employer in writing, and then we take those 2 years and average it out to add it back into the monthly income. And that's something that takes a little more digging into, but it's super critical. You know, if somebody does a loan application with a lender and all they do is just look at the loan application and go off the data on the app, but they don't actually dig into it and verify things, you could get under contract and find out that you don't actually have $500 a month in overtime or bonus that you can use. It might be half of that, you know, or it might be nothing. So it's good to always make sure that you have all of that buttoned up. Do you have any dependents? We do also look to see if you have or receive any child support or alimony. We talk about sources of down payment. We take a look at the assets, and we also talk to people about maybe an option of getting a gift. That's allowable. And then the last section, the declarations and government monitoring questions. We always prep people for this up front, and especially coming out in 2018, they just redid the HMDA declarations, and it's extensively broken out for all different types of ethnicities. And so we want to make sure people understand that this is a positive thing. Like, the government monitors this information, and they actually gather this data up and they look at it because they want to make sure that everybody has the same opportunity and that there's not any discrimination. So it's a positive thing for people to give that information, and that it is being used and is being monitored. So some interesting things. And then just a quick little checklist. These are some of the items that we ask for. Once we take the loan application and we're ready to move forward, we go ahead and ask for documentation. That way we can do all those things that we just talked about to verify everything. And then we're going to let Chris talk to you about credit scoring.
All right.
And how mortgage credit scoring
We
is
got the pro.
different.
Thanks. So let me kind of just start off and explain a little bit about what is a credit score and how it's derived. So when you look at a credit report, you're going to typically see 3 different credit scores on that credit report, right? But why are there 3 different scores? That's usually the big question that people have. So can you tell me why there are 3 different scores on a credit report? Look at you. You've seen this before, maybe you remember. So there's a couple different reasons. Different creditors are going to report to different credit bureaus, okay? So a lot of times you're going to see different scores as a result for that. But then also, algorithms is the big thing here. So the bureaus will use a different algorithm to score the information that they have. So Equifax, Experian, and TransUnion are going to use a different algorithm. Now, there's different methodologies that are used to score your credit report. Now, there's actually over 100 different ways to compute a credit score, okay? And then there's a methodology called FICO. Now, do you remember what FICO stands for? Okay, I'm gonna stop picking on you.
All I can remember is Fair
She
Isaac.
nervously touches her hair.
Yeah, Fair Isaac Corporation. Okay, so FICO is kind of the law of the land when it comes to credit lending. So pretty much 90% of all lending decisions are made using a FICO-driven score. Now, there's 49 different ways to compute a FICO credit score, okay, across 4 different industries. Now, when you go into purchase a vehicle, that is actually going to be a FICO-based score, but a lot of times, if you talk to old car guys, they'll call it like a Beacon score. Well, it is, but Beacon is a company that comes up with credit models, credit algorithms, and so they come up with the ones for the car industry, which is why they call it Beacon score typically, but it's still a FICO score. But it's completely different than a mortgage FICO score. Now, a mortgage FICO score has 9 different algorithms, okay? That means 9 different ways to come up with a mortgage score. But of course, out of those 9, only 3 are used because there's 3 bureaus that we care about: Experian, TransUnion, Equifax. Now, when Debbie and James, when they pull a credit report, The actual names of the algorithms are going to be listed on the credit report. So Beacon 5.0, remember we mentioned Beacon 5.0, Classic 04, Fair Isaac version 2 are going to be the most common ones that are used in the mortgage industry. Okay, and that is what actually computes the credit score. Now that's going to be different when you go online, when you go to Credit Karma, when you go to other sources. Even Identity IQ, which our clients use, is going to be different than a mortgage FICO algorithm. Okay, but the one that matters obviously is the mortgage FICO. Okay, so I wanted to kind of start there so you can kind of get an understanding of exactly what derives a credit score and where does it come from. Okay. Now we're talking here about how do credit scores affect the interest rate. So obviously borrowers with higher credit scores versus borrowers with lower credit scores, but the ones that are in the lower bracket are usually going to have a certain loan type that they're going to be kind of pigeonholed into, which is an FHA loan. Okay, typically, right, guys? And that's usually what's y'all's qualifying range right now for FHA with no
FHA?
overlays or anything like that?
Yeah, I mean, 580 would
580.
be kind of a minimum. I mean, it's just pricing in MI.
600.
Yeah.
600.
Yeah.
Yeah. I mean, there's different factors, but even asking that question is not simple, right? But it's usually going to be a lower credit score borrower for FHA. But now when you get into the conventional world, it's a little bit different. And it's all basically tiered pricing when you get into conventional loans. And so that's where the credit score can make a big difference. And I've had a lot of cases where I've worked with clients that they may have a 680 credit score and maybe they're building a home. I work with them for a few months, and then when they leave my program, they're a 720. So now they've raised their score, say 40 points in that time frame, and they've significantly lowered their payment and decreased their interest rate. So that's really where the credit scoring is going to have a big impact on what you're paying each month. And typically speaking, with an FHA, if you qualify like a 620, that's your rate, right? It's kind of there's not a tiered system, but I know there are different programs and different interest rates for as you get a lower credit score. But typically speaking, when you're talking about conventional loans, they're all going to be tiered pricing.
In the mortgage insurance.
In the mortgage insurance is tiered.
600 or 800 with an FHA.
FHA, yeah. But not conventional. And conventional, it's tiered as well. Obviously, if you're a 620 and you're going conventional, you might get qualified, but you're going to get hosed on the mortgage insurance, right?
Mm-hmm.
Yep.
Exactly.
You touched on it. You talked about the Beacon score and everything else like that, and how car dealership's going to pull one score, mortgage lender's going to pull another score. So just to be very clear, when you go to creditkarma.com and you say, oh look, I've got a 680 and I can go, and it's like, that's not at all realistic, right?
Typically speaking, no. Yeah, when you go to Credit Karma, they're going to use what's called a Vantage methodology. Okay, so where Vantage came from, the three credit bureaus actually got together back in 2006, and they said, hey, we're going to change the way credit scoring is done. So they put together Vantage 1.0, and they were going to pitch it out there to all the lending institutions. Well, they left FICO out of that. FICO kind of got mad, and then they sued, and big lawsuit happened, and FICO won. So then the credit bureau was like, well, we spent all this money and energy developing a scoring model. What are we going to do with it? So they started selling it on the internet. When it first came out, the 1.0 version was a huge difference between that and FICO. The FICO range goes from a 300 to an 850. The original 1.0 range of Vantage went from a 500 to a 990. So you can kind of see how the two really overlap and had this huge gap in the credit scores. Well, then when Vantage 3.0 came out, it has the same range as a FICO score, a 300 to an 850, but still the parameters within Vantage are so different than that of a mortgage FICO score. And mortgage FICO really is the lowest of all of them and probably the pickiest out of all the algorithms, whereas Vantage is not, which is a lot of times why you're going to see higher scores typically with a Vantage score, which is what Credit Karma uses. Now, I have seen some cases where the Vantage score actually comes in lower than a mortgage FICO score. Doesn't happen that often, but that's because the algorithms are using the same range, but it's just the parameters and things that we're looking at that are scoring differently. So that's probably why sometimes it can come in lower, but most of the time when you look at a Credit Karma, so if you're out there talking with a buyer and they say, oh yeah, let me pull up my credit score on my phone. Yeah, hey look, it says I'm a 660. You're like, well, let's hold your horses a little bit. Let's have Debbie and James pull the credit report and see what the scores are, because it might be something like a 615 or something. And they may still qualify, but they may not be as, quite as mortgage prepared as they once thought. Or maybe it shows them they're 620 and they get all giddy, and then it comes back at a 570 and they're like, and their dreams are crushed, and that happens all the time. Does that happen quite a bit with borrowers when you're talking to them?
Yeah, it's a conversation that we have quite often.
Yeah. Probably several times a day.
But listening to your classes has helped me be able to explain it to people better.
Good.
Yeah.
And that's the big part that I talk about, in the beginning of both my CE class and the home buyer classes that I do, is I want to talk about where does their credit score come from. It's really I think it's the most important thing for a realtor to learn, is where does their credit score come from? Because then you can understand, because you guys are going to be the ones that are on the front lines with the borrowers, actually talking with them. So when you show them a home, or maybe you meet them through a friend, or you're on the phone with them and they tell you their credit score, you can't just go, oh, okay, well, yeah, Debbie told me 620 is good, and they said 620, so okay, let's write a contract, boom. And you go out there and write a contract, and you hand it over to Debbie, and Debbie gets it on the Sunday, and she's like, pulls credit and be like, I'm sorry guys, it actually came back at a 572, and you just wrote a contract. That's not a good deal, Now you have 30 days to close, and then Debbie comes to me and says, hey Chris, can you work a miracle in 30 days? I'm like,
we would never do that to you, bro.
That's never happened. But obviously when you look at credit scores, anything above a 740 is going to be, pretty much the best you can get. You're going to get the best rate and the best pricing and everything out there. I've had some cases where clients have like a 780, and they come to me and they want to what can I do to get my score to an 800? I'm about to buy a home. And I'm like, nothing, go fishing, go golfing. Don't worry about it. Okay, you got a 780 credit score, stop sweating it. It doesn't matter. So yeah, it is difficult but possible to get a mortgage credit score under a 620. But the pricing is going to change, the stipulations are going to change. I've heard stories of people getting FHA loans done at a 530, but it's somebody coming in putting 50% down, having a couple $100,000 in cash reserves, a lot of different stipulations on top of it, that usually speaking, when somebody has a credit score like that, that's not the case. They don't have, they don't have a situation where, they've got all this money sitting around and they have a 530 credit score.
Right.
So no credit. So building credit is a big, important part of, raising your credit score. So for clients that don't have a credit card, the mortgage FICO scoring model is broken down into 5 parts. Okay, almost like the pizza we have here, pizza pie, right? 30% of it is just the balances you carry on your credit cards. Okay, so it's your revolving accounts. Now, revolving account is a credit card. Okay, that means you're borrowing money on a line of credit, you're paying it back, and then you can borrow back against it again. Okay, but if you don't have a credit card in the 30% section, you're not scoring in there. So a lot of times when we see people that have lower credit scores, like in the mid 500s, typically speaking, a lot of times it's because they don't have credit cards. Okay, so then we're going to actually talk to clients about getting a secured credit card. And sometimes people are like, well, I can't get a credit card because I got bad credit, and they don't quite understand what a secured credit card is. Or maybe they even went to their bank like Wells Fargo. If you got a 530 credit score, you walk into your Wells Fargo bank and apply for a secured credit card, you're gonna get turned down. And they're like, well, Chris, I can't even get a secured credit card. I'm like, well, that's not true. So we actually have sources where we can point people to that do not pull credit, and that will give them a secured credit card. And there's a lot of other misunderstandings too about secured credit cards. I've had clients too that have credit cards, and they've been told, I remember this was a long time ago, but I talked to somebody on the phone that had 3 credit cards, and they signed up with a credit repair company, and the credit repair company said, go open up 2 secured credit cards. That's going to help raise your credit score. And they did, and their credit scores dropped, and they were upset, and of course they left that company, and they came to me, and it was like, well, Chris, why did my credit scores drop? They told me, and I've heard that opening up secured credit cards gives you points on your credit score. I'm like, yeah, but not if you have 3 credit cards already. Mm-hmm. And it's because of that 30% section. So if you're starting from scratch and you have 0, and then you add something that's positive to it, it's going to give you a bonus. You're going to get those points. But if you already are scoring in that section, adding more credit cards there could actually hurt your credit score. Mm-hmm. So depending on the scenario, it could actually lower your length of credit history. But also anytime you open up a new account, you lose points initially for opening up the new account. And so a lot of times you're going to see that score decrease as a result. Mm-hmm. But if you don't have anything scoring in there and you open up something new, it's a yin and a yang. One goes up, one goes down, but the up is more than the down. And then as that down goes away, it's going to continue to go up even more. So that's why secured credit cards can be a very important piece to building credit and building credit score for a lot of borrowers. And then also, it says here, becoming a co-signer or becoming an authorized user. So becoming an authorized user, I actually had a loan officer last week that emailed me about this very same thing and said, I have somebody who's moved here recently from another country, is a ghost credit-wise, but I guess his wife had credit, and I didn't know that in the original email. And I was like, well, if he has somebody that he can get added onto as an authorized user, that would be great. And he's like, well, yeah, well, his wife. I'm like, well, yeah, do that. And so that's gonna, he get added to 2 cards, and he's gonna get an instant credit score, whereas before he was a ghost, credit-wise. So getting added on as an authorized user can be a big part to help raising your credit score. Another story I like to tell, the couple that I had down in Cibolo, they were moving and building a new home down in Cibolo, and she had great credit, all scores in the 800s. She had credit cards that had been opened up since like the mid-70s. All of them were like huge limits, small balances, and he was, I guess maybe she found him under a rock somewhere, but I'm just kidding. But it was like their 3rd marriage or something. But they were a great couple. They actually took me to dinner after I raised his score 90 points. So, but he got added onto her credit cards after he had nothing. All he had was collections on his credit report across the board. He had a 570 credit score. He got added onto 3 of her credit cards, and his score within 3 weeks raised 90 points. Wow. So, and then by the time we got all the negative stuff off of his credit report, his score was, in the mid 700s. So by the time they closed on the loan, he was like a 760. So going back to the thing we talked about before about scoring, but does that happen with everybody? No, but he was in a good situation where he could immediately build amazing positive credit, And there's cases where you could actually put somebody on as an authorized user, and that person could have better credit than you, better credit score. So, I could actually take my oldest card, and if my son was old enough, or maybe my nephew or something, put him on that card, he could have a huge instant credit score, and it might even be higher than mine,
That was going to be my question is, putting a child on, who's just now 19, 20, something like that, as a signer.
Yeah, it could be, I've seen it before where people have got all of their cards are maxed out, but they have this one that's been open up for a long time, and they keep it low, and they add a child or something onto that one. So now the child has a bigger credit score than the parents.
Gotcha.
Because that's the only thing that's showing up on their credit report. And then and establish credit for rent, cell phone, utilities, etc. And this is obviously very important when it comes to alternative trade lines and things like that. Now, when I'm talking to people usually about building credit, I will talk to them about hey, alternative trade lines are great, but not everybody has all of those alternative trade lines. So let's build the necessary trade lines that you need for the mortgage. Because what is it? You have to have at least 3, and you have to have 12 months of history? Is it 2?
Yeah, they have to show
12 months. Yeah. And a lot of times, when I'm building somebody from scratch, we may have 12 months to work with. Somebody tells me oh yeah, Chris, I want to buy a house in the next 18 months, and I've got a 490 credit score. Okay, great. Well, that's, we got time to work with, but let's build that credit. And then I've heard people say, well, doesn't my rent count as credit? Because that's what I was told. It's Well, no, not necessarily. Rent counts as an alternative trade line if you need it to show and meet the guidelines of FHA, but it does not impact your credit score, okay? So that's where building credit, adding credit cards, things like that can help, which is why we usually say to have 2 to 3 credit cards and then like at least 1 installment loan. So if you had 2 credit cards and 1 installment loan, that gives you 3 lines of credit. You can keep those open for 12 months. They're gonna really help your credit score because the age of them, but then also you're gonna meet that criteria of 3 trade lines without having to go through a whole bunch of paperwork and making Debbie's and James' life, really hard by having to search for a lot of paperwork to come up with that alternative trade line. So
We don't mind.
So tips to build credit. Credit limit increase. That is a big one that because from people that have credit cards, the percentage of utilization is really what is how you're scored. So the higher the percentage of utilization, then the less points that credit card is earning towards your credit score. The lower the percentage of utilization, the more points it's earning towards your credit score. So if you have a credit card that's got a $2,000 limit, you have $1,800 on there, and you request a credit limit increase, now it's $4,000. It's gone from 95% or whatever that is to something less than 50%, right? So anytime you can increase credit limit, that's going to be a good thing. I've had people tell me in the past, like, well, I was told that having too much credit, limit is bad and that hurts your credit score, and that's a myth. That's not true at all. So anything you can do to, request and increase your credit limit is good. And a lot of times you can do that online. You can go request a credit limit increase, online for your card. And a lot of times they'll only do a soft pull. They won't do a hard pull to do that. Now, obviously, if you've got bad credit scores and you're in the 550s and you're trying to get a credit limit increase, it's probably not going to happen. But if you're a borrower that's at like a 650 and you're trying to get up there, because remember we talked about the conventionals and you're trying to go that route, if you get a credit limit increase and increase your credit score that way and go from a 650 to a 680, that's a big price difference when you're talking about your interest rate.
I think we have a pregunta.
So when you increase your credit limit on a card, does it affect your credit score as an inquiry?
No, a lot of times it's going to be a soft pull, so a soft inquiry. There's no negative impact to your score that way. So take out an installment loan. We kind of talked about that. Obtain a secured loan from a bank. Those are just different ways to, if you're starting from scratch, how in building credit, ways to actually increase your scores by adding a loan. Now, here's the thing that I always talk about. That is when you are, I guess kind of check with me when you're talking about building loans and getting new loans. But the general rule of thumb is if you've got one credit card and it's been opened up for 15 years and you're saying like, oh, well, I need an installment loan, so that's going to help me, right? Well, it might help you in one particular section of the scoring model, but it's actually going to lower your credit score because your credit history is an average of your open and active, credit history. So if you have one credit card that's been opened up for 15 years and you open up one more, like if you go get a secured loan and thinking that secured loan is going to help me increase my credit score, well, now what's your credit history? It's 7.5 years, right? Because it's an average. So, and by lowering your credit history average, your scores are going to drop. So you have to be careful. But if you're starting from scratch, or if you have maybe 2 credit cards, you opened them up 6 months ago, then yeah, getting an installment loan is definitely going to be helpful, in a helpful part of building your credit score. So asking your landlord, there actually is a service, and I can't remember the name of it right now, that you can go to, and but the landlord actually has to opt into it, and they can, if they opt into it, they can actually report payments on rent to the credit bureaus. I'll do some research and I'll actually post their link on my Facebook page tonight. So, but I've seen them before and I've looked into them, and but I need to get back in touch with them anyway. So that's be a research project. But their benefit to the people that the landlord is that they get more on-time payments from their renters by doing it. But then, and the benefit for the renters obviously is that reports on the credit bureaus. So, and obviously I think it kind of goes without saying, but paying your bills on time, same time every month, and managing your credit card ratios is very important in it. And I think sometimes people don't understand quite the impact that making just one late payment can have on their credit score. One late payment could drop your scores as much as 170 points. Just one late payment. Yeah. Make it have I talked to somebody recently where their scores were like low 600s and they were like, mid to upper 7s, and all it was just one late payment. Now, you get those points back pretty quickly with a late payment, but that first month that you see it, it's devastating. Because also, and the big reason why it is so devastating is because when it reports, not only does it report the late payment, but it also reports the past due balance. So now you've got two negative aspects of that trade line. You've got the new late, plus whenever you show a past due balance, it's also negative. So it's boom, it's a big bomb that drops on their credit score. Now, if you're a 580 credit score or 560 and you make a late payment, it's going to impact your credit score. It's not going to take you down to a low 400, but the higher you are, the bigger you fall type of thing. In the credit world, it's definitely like that. So if you're in the high 700s and you have if you miss a payment on something, your score is going to drop pretty heavy. They're also pretty hard to remove, but if that's your only late payment and you've been with them, let's say it's Capital One, something happened, and it's the only late payment you've ever had, and you've had that card for 15 years, call them up. A lot of times they'll give you like a one-time grace period. Just tell them, that you might have to fib a little bit and just say, because if you just say, oh, I forgot, they may not give it to you. But if you basically say, hey, I made the payment, but I forgot to hit the submit button, or I thought I hit submit, but maybe it didn't go through or something, but I know I paid it. A lot of times they might give you a one-time forgiveness on that. And I've actually had success, because I know there was an issue with an account that I had when I was paying off a truck loan. I paid it off, but when they did, they screwed something up, and then they ended up reporting 2 lates for me on my Tahoe when I paid it off years ago. And then I went to the bank and I was like, what's going on? I demanded a letter from them saying, I want a letter saying this isn't right. And they told me basically they wouldn't give it to me. But then I challenged it and it came off right away. So when I asked them for the information on it, so usually when there's things like that, and there's usually outstanding circumstances with it, we can usually go after and get it fixed. But if there's not, the best way for cases like that is to kind of ask for that one-time forgiveness letter. So debt to income ratio, do you guys want to jump back in on this?
Do you have anything to say about it?
So debt to income ratio, I think the biggest thing with it is it doesn't impact the credit score, the DTI, and I get that a lot of times where people, they're looking at like, oh, I need help with my credit, and I'm like, and I dig deeper, like, well, your credit scores are good, and then I dig, and I'm like, well, it's really a DTI issue, and it's what some people don't understand is that debt to income does not impact your credit score. How much money you make does not impact your credit score. I had a client here locally who was worth $100 million, but he had a 660 credit score. Okay, so it did not, because he's like, I don't really care about paying bills. I'm rich. So
Wow.
that was his attitude. But the point is that some people think like, oh, I have bad credit because I don't make a lot of money. No, that's not true at all. Because remember we talked about the scenario of putting your college kid on the credit card and your college kid doesn't have a job. Well, you can have zero income and have a high credit score. Now when we end up, fixing someone's credit, a lot of times we're getting a lot of erroneous stuff off their credit report, or even things that are valid that have erroneous information on there. And by erasing the dollar amounts of those collections, helps this part right here. So
For sure.
a lot of
Yeah.
times when I'm going through a credit report and getting things removed, that DTI is getting better because the lender is going to have to take anything that's non-medical that's over $2,000 of an FHA loan and take 5% of that and
Right.
count it towards your debt to income ratio. Did I get
That's
those
right.
numbers right?
Exactly right. Yeah.
Yeah. So and it's non-medical. So medicals don't count to your DTI, but it's all the other things, right?
Right.
And the charge-offs don't count in that either,
Correct.
Right.
it's just the collection stuff. So as we get those collections removed, it's helping the DTI. So, and obviously that affects pricing and everything else like that.
That's excellent.
Yeah. Anything else you guys want to add to the DTI part?
I think we have another slide on DTI actually.
Okay.
Yep.
Man, there was no way that we could have delivered that data in.
That was excellent.
Man, yeah.
Is this y'all's?
Yeah, I'll,
Yeah,
I'll let
yeah.
James jump in.
Cool.
This
All
he
right.
loves explaining that.
Yeah, and I'll keep it real quick here, but debt to income ratio is really very self-explanatory in that it truly is your debts relative to your income. So I like a visual graph. I think it's really helpful, and so you can see that we got about 60% here. This is going to be your income relative to your debts. And then what's relevant is, as you can see here, the equation. What's relevant is this number right here. Actually, there are particular thresholds as we're from a lending perspective. So whether it's 40 or 32 or 28, those numbers mean something to us.
And by the way, they're getting smaller. So it used to be that they would go all the way up to 50, and now they're lowering those thresholds like closer to 45,
Yeah, they
46.
flexed again,
Oh, okay.
which is
So-
really interesting because they increased.
Things are always constantly changing.
Yeah. So the bottom line is it's really the debts relative to your income. So we like to put this up to help people understand that if you qualify for a particular payment, if you want to qualify for a particular payment, all that we can do is either impact your debt load or your income. That is to say, get a raise or pay off a credit card. And that's just a simplification of how to improve your debt to income ratio, which is such an important piece of qualification.
And a lot of times, too, people think that making a larger down payment is going to help, when in reality, if they have debt, put down a smaller down payment and pay down the debt, and then you get,
So good.
and then it really decreases the debt to income ratio.
Because that
much
impacts
quicker rate.
this. That impacts this
That's a hack.
in a big way. Yeah. And just so you know, a 43 debt to income ratio, that's just kind of the magic number. If you're at a 43 debt to income ratio, so if you kind of want to do it in your head, okay, and it's before tax, so okay, I make $5,000 a month, good for you, and I have $100 in credit cards, a $300 car payment, and my rent's going to be $1,000. Add up your debts, divide it into your income, and that's going to be your debt to income ratio. If you're less than 50, around 43, you're going to be in good shape.
Let me pause you there because you said your rent. Because usually when we calculate, it's kind of like we take the debt, so credit cards, etc., and the rent is not included, and that gives the DTI.
Okay, so in fact, the way the debt to income is going to work is that there is what's known as a front end and a back end, just industry vernacular for two different types of ratios. And so the first one is just rent or mortgage.
Or housing expense.
Housing expense, exactly. And then the back end is all the debt. So those are the two types. Those are the two ratios that we look at: is just the housing, and then all of your debt, housing, credit cards, car payments, all.
So the back end ratio could fit the standard, but the front end could be too high. So you could get approved or ineligible because of that. And then it really comes into play with USDA because their front end ratio is really low.
Mm-hmm.
So we have to really pay attention to
Yeah.
that.
On the DTI thing, one thing I would add is just, if you want to add about self-employed, people that are self-employed and what that impact that has on DTI.
Yeah, I mean, it's with self-employed income, it's just a lot more complicated, obviously. If you're looking at someone that just is hourly, then that's really simple. But if you are self-employed, then we're going to be going into the tax returns, and we're going to be looking at all sorts of different moving pieces that are going to impact your income, which, as we know, is half of what the debt to income ratio is incorporated of. So, definitely adds a layer of complexity to
Yeah,
the
because I've always had people that have had issues that are self-employed, they make good money,
Mm-hmm.
but they only report on their taxes like, oh, I only make 20 grand, you know, but they're really making like 150 a year or something, right?
Yeah.
And then they go to buy a home thinking like, okay, this is great. Well, guess what? You can only use the 20,000.
Yeah.
So.
And you know what, that's exactly why we go ahead and get the 2 years tax returns right up front, and we have them analyzed by, you know, an underwriter, so that they can go through all the schedules and determine what's being deducted and what can be added back in,
Yeah.
and gives us a bottom line before we ever even move forward with the application process. So
Yeah.
it is so complicated and so complex.
Yep. I love a good chart. I love a good graph. Okay, I love to visualize. I think it helps me. So this is the monthly payment visualized in a graph here, and what this is showing you that. So there are a couple different pieces to a mortgage payment. You've got, and I'll go back through this, but principal and interest. You've got your homeowner's insurance, real estate taxes, and potentially mortgage insurance. Okay, so principal and interest is your loan. Okay, that's the part that Debbie and I impact. That's what your interest rate's going to have to do with, and it is essentially the balance that you're contributing towards your equity in your home. Okay, so that's the principal and interest, and that's the fun part. And then the other pieces are it's like death and taxes. It's just what you have to pay, and it's like car insurance. Okay, it's the exact same thing, right? And then property taxes. And then the point of this graph here is to illustrate to you that principal and interest is this piece right here, nice and big, okay? And this blue piece, which is like 40% of this circle, is property taxes. So you're paying a lot in property taxes, okay? And I just love to visualize it like this because people freak out about mortgage insurance. Well, guess what? That's a little bit right here. So, you know, it's a small price to pay, obviously, to own a home. We can kind of get into more of that if you want to, but again, the thing that I like to visualize for you is just, this is property taxes in the state of Texas. It's pretty extreme, so it's going to be a lot of your payment, but it's just the way that it is, unfortunately. So, and then this is really in the weeds here, so I'll let Debbie go into this.
So these are actual loan scenarios for loans that we have in our system right now, and I just thought you guys might like to see. This is just a snip out of our software system, so you can kind of see what we're working with here, and it's how the loans are built. So this is a conventional 30-year fixed loan. It's a 3% down payment. The purchase price is $151, so you can kind of see what the down payment would look like, and then what the loan amount is. And then these are current interest rates as of today. I looked those up today. And then I blew up the total monthly payments so you can then see the breakdown that James was just talking about actually represented in numbers.
Yeah.
So that this
Principal and
amount
interest.
appears, principal and interest, that's going to remain the same throughout the life of the loan. It's not going to change as long as you have a 30-year, as long as you have a fixed loan product, I should say. We might start getting into seeing some adjustable rate mortgages again in the near future. Hazard insurance, real estate taxes, and then a little bit there for mortgage insurance. And then you can kind of see that that's your total payment. So, and then here's a different scenario, different sales price, but with 5% down, and you can see the monthly payment there. And then 20% down, this is where it significantly impacts the monthly payment because the mortgage insurance goes away.
And I like that you're doing that because it shows you too that, because people think, oh, I've got to have $20,000, $15,000 in order to buy a home, and that's just not the case.
Right.
It's only if you're having an investment that you need to go with
That's
20%
correct.
down, or a second home.
10%
So,
down.
yeah,
Mhm.
thank you
Right,
for clarifying
yeah.
that. So,
And again, like we were saying too, people sometimes start out thinking that they need to put a large amount of money down as a down payment, when we may want to just try to preserve cash because they're going to want to fix up the house once they move in, or
Yeah.
they may benefit from paying down debt. So we might look at a scenario where what's the least amount that we can put down.
there you go.
Mm-hmm.
Okay.
So we do a lot of counseling like that, and then once people see that, they are like, oh, okay, well that makes more sense now. So putting more money down isn't necessarily the best route, especially if it's going to be under 20%, because it doesn't really significantly impact the payment until you get to that point where you can drop off the mortgage insurance. And if it's a conventional loan, which we love that 3% down first-time home buyer product that we have, Home Possible and Home Ready.
Oh, thank
Um,
you. Yeah.
With a conventional loan, the mortgage insurance will eventually drop off. So that's a plus as well. And it used to be that you couldn't get a mortgage loan if you didn't have 20% to put down. So mortgage insurance has allowed people a lot more options. So it's a very positive thing. So we want to talk a little bit about mortgage rates and how they're determined. It's such a hot topic right now because they're on the move. You know, we got used to being like super low for a period of time, and now things are changing and we need to evolve. So this is basically how a lender comes up with your mortgage rate. So people call all the time. This is like one of the things that's the biggest misconception in the industry. They call all the time and say, oh, I saw it advertised at such and such for this, or I saw it was this online. I'm like, that's not a real rate. So the reason is because it's comprised of a lot of different things. And so when we give our borrowers an interest rate, it's actually done through this software system that's tied into Wall Street. So it's a live pricing engine.
Oh.
And it works on an algorithm, kind of like credit scores do, where it takes all of these parts into consideration. So it looks at your credit score, it looks to see what your down payment is. It depends on if it's a purchase or if it's a refinance or a cash out, because those rates are different. It depends on if it's your primary residence or it's a second home or an investment property. It depends on the loan amount. And then it looks to see if you're paying any portion of the points down to buy down the rate. And then mainly in the middle here, it's driven by the economy. So at the end of the day, if stocks are doing well, if bonds are not, you know, all of those things affect how the interest rates are going to be driven, and it's been very volatile lately. So it's just something to understand that everybody's interest rate is going to be unique to them, just like their credit score is going to be unique to them. There's not a one size fits all. And if somebody gives you an interest rate quote and they haven't done your loan application, pulled your credit, they're not really giving you a real rate. So I found this website that I thought was really interesting. It's called thetruthaboutmortgage.com, and so I'm going to start using some of their materials, but I just went on and found this. And so this is an example that they gave that just says what I just said. So you'll see this rate advertised, but then it'll be like some crazy scenario that doesn't really exist. You know, 760 credit score with 20% down, on owner-occupied, single-family home, you know, with a loan of $300,000, and then you have to pay points on top of that. So that's what they're not telling you is like, what's the hidden cost behind it?
Stand on one leg.
Yeah, this rate exists for somebody maybe somewhere out there, and you know, in fictitious land. So just be careful about what you see for advertised rates. Another thing to be super careful about is, and James, I got this from him, he calls it clickbait. Because a pop-up will come up. They know you're looking for a home, right? So a pop-up will come up online and you click on that. Well, now they've captured your URL and they're going to start sending you all kinds of advertisement, and they're probably selling your information to other places so that they can continue, you know, using you as a source for advertising. So just be aware of that too. So this is today's rates for one of these loan scenarios that I just showed you guys. Again, all based on all of those different things, and it's all just an algorithm. But I just wanted to explain how this looks when we go in to price someone's interest rate and give them a quote. So this number here, as close to zero or as close to no cost as we can get, that's called par. And so all of these rates, this is kind of weird today, but all of these rates are available today at a credit.
See what this? All right. So what this is telling us right here is that the economy is so volatile right now that they don't feel comfortable really provide. You see how it's digressing, right, at kind of a steady rate, and then here it just kind of plateaus inexplicably. They don't really know what interest rates are going to do. So to hedge against the volatility, they're just like, okay, we're only going to give you so much for these rates. Essentially.
So it doesn't make sense to buy this rate down today.
Right.
Gotcha.
The yield curve
to
is
get a
going
credit
over.
for this rate today.
Right.
And then in the other direction, you can have the lower interest rate at a cost. So that's what they call points. That's when you buy down the rate.
And every lender can do that.
And then this column over here is the principal and interest. So you can see how minutely affected the actual payment is.
Yeah, so it's like
Incrementally.
$11. So you spend $1,800, you know, for $22 less a month. It might be worth it, but it comes down to dollars and cents, right?
So you take that $22 and you divide it out over how long you're going to own the home. So that's when you have to figure out if it makes sense. Are you going to own the home for 5 years, 10 years, or 30 years? So where's your break-even point? Does it really make sense to pay down the interest rate if you're not going to have the house for very long?
Right,
The
so-
answer is,
so
at
for
some
this
point
one-
is no.
It's 7 years. You have to own the house for 7 years, and at that point,
And then it starts making sense.
well, you start accruing $22 a
Then
month.
you broke even.
So you tell me.
Yeah.
Yeah.
I mean, maybe, yes.
So Starbucks, coffee.
So-
Starbucks, there you go, yeah, exactly. So,
But you have to ask yourself, is that $1,800 in your pocket? Can you do something better
is
with
there
it?
value, is there some value to that?
Can
Over the
you invest
course
in
of 7
something,
years,
or
could
can
you have
you
done
use it
something?
for
Pay down more
something
debt.
else? Yeah,
Yes.
Mhm.
exactly.
So,
So it's not always the right thing to do. And so we try to educate people on how it actually works so that they understand.
so this is just talking about interest rates going up, and I think the best example is the fact that last time we did this presentation, so if you notice the interest rate right there was 4.875. Last time we did this presentation, it was 4.
That was
So-
in November.
Yeah. So it's going crazy. Yeah. Now, the one thing that I do want to say about rising interest rates is rising interest rates are a consequence of a hot economy. Okay? And so some of the other side effects of a hot economy is inflation, okay, appreciation, and both of those things work in your favor when you have fixed debt. So as your house appreciates and inflation starts to kick in, that's going to be money in your pocket essentially. So it's a cost benefit analysis between having a low rate where you're saving a little bit of money versus taking a higher rate when the economy is killing it and you start making money. So it's kind of the cost. It's kind of the cost there. So interest rates are going crazy right now, but there's a silver lining. So it's kind of like it's raining, you know, makes the grass grow.
That was awesome. So this is just a breakdown on some different loan types that we have. So there's your traditional, conventional with a minimum credit score of 620, as low as down as 3%. The FHA loan, which is a great product for a lot of people, with as low as 3.5% down. And where we really see the difference between the conventional 3% and the FHA 3.5% is anyone with a credit score of 700 or greater. So if this credit score is less than 700, then it makes more sense to do, right now to do FHA
And Chris was saying,
because the mortgage insurance is less. So we compare both products for every person to see what's going to make the most sense for them. Of course, VA, if you're a veteran, is fantastic, and then USDA is a zero down program with a really small box. So you have to fit all those boxes to qualify, and of course, it has to be in a USDA eligible area. And we have some great programs for first-time home buyers. So we have our Home Ready and Home Possible products with 3% down. We also offer a mortgage credit certificate, which gives you the ability to take a tax credit either off of your paycheck or if you itemize your taxes, you can take it off once a year. And now we also have a down payment assistance program, and James and I are certified for all these programs. So yeah, we're looking forward to helping some people with that. And we're going to talk about budgets next. So we have these budget worksheets that we passed out. And I always tell people that learn to live on a budget now before you go out and buy a house. So like instead of putting in your what your monthly rent is right now, put in the house payment that you're going to be paying. Go ahead and live like you're already making that payment, and also include, you know, what your projected utilities are going to be like, if you have yard expense, anything like that. Like go ahead and fit those numbers in and give it a try and see how that feels. But on the other hand too, it's designed to help you like control your expenses and save money so that when you get to that point that you don't feel too stretched. So there's some stipulations around what we can use for down payment and closing costs, and we have a lot of times people will ask them, okay, well, tell us about the source of your down payment. They'll say, oh, cash, and we'll be like, What do you mean by that? Define cash.
It's laundered.
Yeah. Yeah. So.
Okay. Yeah, that works.
Texas is a money laundering state, so there's a lot of documentation that lenders and banks have to follow. So any large deposits that show up on your bank statements get flagged. We can't actually use actual cash. So you can't take out a loan or a credit card advance. We've had people try to do that in the past. But you can get a gift from a family member, and anything that can be sourced and documented as deposits into your bank account other than cash can generally be used as well. So just something to be aware of.
What movie? Come on.
Yeah. So start saving up money, paying down debt. Some things that people do, get a temporary second job. James did that so that he could get into his house. Yep. Gift from a relative. Just remember you have to source and document all deposits going into your bank statements, so be diligent about that and mindful of that. You can liquidate an asset account, so if you have a stock or a 401k or a retirement account, that's an option. And then it depends on the real estate market and the environment, but you could see some seller credit and or lender credit. It depends on what's available. And we already saw that today the lender credit wasn't looking too good.
Yeah.
So that's kind of going away now, as seller credit's probably going to start phasing out now as well. So pro tip, I tell people instead of taking money out of their 401k, it's allowable for them to borrow against their 401k. So I know we said you can't take out a loan for your down payment, but this would be the exception because it's already your money. You're just borrowing against it. So that way you're not hit with all of the tax consequences when you pull the money out of your 401k. So we've had a lot of people do this successfully. And then another thing too, just to make sure people understand, there's a down payment and then there's still closing costs attached, right? So we just want to, we give a full loan estimate so people can see the entire breakdown, and we have little to do with anything except our origination cost. So the rest of it's going to be property tax, insurance, title fees, whatever the state charges for recording, that sort of thing. So just real quickly, some do's and don'ts after you get your loan approval. Please don't quit or change jobs without letting us know it's happened. Don't apply for any new credit cards unless Chris tells you to. Don't make any major purchases. Don't dispute anything on your credit report unless you're working with a professional. Don't enter any deferred payment plans. Don't close any revolving credit accounts, again, unless you're under the advice of a professional, because that can mess you up too. Don't co-sign on any loans for anybody. Don't acquire any NSF fees, and this actually killed a loan of mine. The underwriters use NSF fees just as a negative item on your credit report, and it has to be explained. So be really careful about that. Don't skip missed payments or pay late. Don't pay off collections or charge-offs. Don't max out existing credit cards, and we want to stay below the 50% limit like Chris was talking about earlier. Don't make any adjustments or transfers into your asset picture without talking to us first. And don't make any large unexplained deposits into your bank accounts.
Just don't do anything.
But those are all things that have been deal killers in the past. So they do happen, and people just don't know if they're not told.
When you say like deposits or things in your bank account, you're looking at what they ask you for 2 month bank statements, right?
That's right, yeah. So anything other than a payroll deposit, if it's like coming from a PayPal account or it came from some source that can't be identified by the underwriter, it's going to require an explanation. And then that will further determine whether the underwriter will let us even use it for funds or not. And if it's a gift from a relative and it can be documented, then that's acceptable. But yeah, it'll, like you said, it'll be whatever's showing on those 2 month bank statements. So pro tip is if you've got anything that needs to be deposited without scrutiny, do it before you have to give bank statements. So that's about it, guys.
Fun
Those
picture.
were kind of talked about all the different different parts of the mortgage. There's a lot of moving parts. It's important that you work with somebody that you know, like, and trust. Because it can be a really daunting process, and there's a lot of complexities around it.
I think the key to that too is that you're not alone in this process.
That's
you know,
right.
number one is you've got your realtor, and then you've got your lender, and they work together as a team. And then you've got your credit repair. So,
Yeah.
yay!
Yes.
So you've got all these elements. So you don't have to know everything. It's good to have this overall picture, but you don't have to know everything, because that's why you have your realtor and your lender, who you can call, text, you know, whatever, and they're available. So
That is,
That's
that is
exactly
so
right.
key, is to have the right team in place
the
to
team.
help you.
There you go.
Right.
The team.
So just some quick recap on this. Start a loan application now, even if you aren't sure when you're buying. Schedule a lender consultation, determine what you qualify for, and put a plan in place. Work with a buyer's agent and identify what you can afford. And always tell people too that there's a huge need for working with a buyer's agent, because if you're just calling randomly on a sign, guess what? You're getting the listing agent, and the listing agent is working for the seller, and that can cost you thousands of dollars. So if you're concerned about interest rates at all, you need to really be concerned about what it's going to cost you if you're not working with a buyer's agent. And there's no fee involved for doing it. So there's absolutely zero reason to not work with a buyer's agent. You want to definitely make sure that you're being represented. Work on your credit score with Chris.
Chris.
Yep. Save money for your down payment and closing cost. Gift, of course, we can explore a down payment assistance program now if it fits. Learn to live on your new budget and ask lots of questions. And make your dream come true. Yay! Yay! Thank you guys.
Thank you.
That was awesome.
Good. Thanks.
Thank you, Facebook people.